G'day guys, and welcome to another episode of Stocks to Watch. Now today we've got a special guest, Don Durrett, who is the owner and founder of goldstockdata.com. And we are just having a chat off mic before, and he said he started it in 2012. Bit of a bear market, but now he's seeing a hell of a bull market coming through. So Don, welcome to the show and good to meet you.
Yeah, John, nice to meet you too. When you say good day, I know you're Aussie.
Exactly. Yeah, it's hard to keep that one under wraps, but yeah, but you know us Aussies, we love gold, so yeah, plenty to talk about there. So I guess first up, I'd like to not focus on gold, but focus on silver because that's just such a buzzword in the market across everyone from juniors to producers, and this whole idea of a potential silver squeeze. Now, what do you think the possibilities of that actually happening and prices going plus 100?
Extremely high, actually. So I wrote a book in 2010, go way back to, so I started investing in juniors in 2004 and there was no books. So after I learned how to do it, I'm a writer and author. So I said, well, I'll write it. So when I wrote that book in 2010, I talked about that squeeze, about that possibility. And I back then, 2010, I said it was likely. And the reason why a squeeze is likely is because 70%, and back then it was 80% of all silver is used by fabricators because silver is the most electrical, most conducive metal. And so it's used in anything electronic. And we're in a technological age. So, I mean, just solar panel alone uses like 20% of all the silver, like 200 million ounces. And it just goes from there. Any automobile, any vehicle, any airplane, anything, any TV, any phone, they all use silver. So there's not enough silver for both fabricators, now it's about 70%, and investors because the ETFs keep sucking up all the supply. For the last 4 years, we've had deficits. In other words, the amount of silver that's mined it can't keep up with demand. So we've had to use above ground inventories, and it's averaged about 150 million ounce deficit for the last 4 years. And they said it's going to happen. That deficit is going to be there for the rest of the decade, 100 million ounces plus. So if investors, and I think they will, continue to desire silver, then I think we're going to run out. Now, and that's where the squeeze comes in. And I think the LBMA is really the weak point because the LBMA is an over-the-counter market. So the way that works, if you want to buy silver, you just go there and buy it, just like you're buying at retail, but it's more wholesale there. But that's the largest over-the-counter market in the world, and they've been starting to have issues already. And I said that it would start at $45 silver. That's when I thought that we would start to see pressure on basically the supply, and we're already starting to see it. And so the possibility of squeeze is probable in my opinion. And the reason why is because silver, like the fabricators, they use 1,000 ounce bars, and they're like they basically weigh about 70 pounds. They're never exactly 1,000 ounces, but they're right around 1,000 ounces, around 70 pounds. That's a pretty heavy bar. They're big bricks, and that is what everything is made into. So all your jewelry, but anything is made. All the fabricators, they don't buy 100 ounce bars or kilo bars. They buy 1,000 ounce bars for all the fabricators. So that's the main inventory. And then as investors, we buy kilo bars, 100 ounce bars, 10 ounce bars, 5 ounce bars, and then coins or rounds. And so those are all made from the 1,000 ounce bars. And so the key to a squeeze is lack of 1,000 ounce bars. So once 1,000 ounce bars are gone, then the fives and tens will be gone first, and then but if you can't find any 1,000s to replace those fives and tens, then you have it, they just disappear real quickly. So all the inventory will just, basically have a run on 1,000 ounce bars. I'm expecting it, but it's kind of a catch 22 as investors. For instance, I'm very comfortable buying gold mining stocks, and I feel like the winds at our back, we own gold mining stocks because the biggest correction I think we've had in gold in the last 2 years is like 12. We just had one, 12%. I think that's the biggest one we've had in a couple of years. And I don't really expect any deep corrections in gold. I just see we're just going to go higher. There really isn't any significant risk, in my opinion, to owning gold and gold miners for the next couple of years. And so it's a really good risk reward investment. Whereas silver is a different animal. Silver,
Yeah.
it can be hugely volatile. And we don't know what to expect. So I'm expecting gold to trend up to at least 6,000. Now, if silver trends to 6,000, we're currently about a little over 1%. In theory, silver could still be at $60 in possibility, right? I'm expecting it to go to at least 2%. That'd be $120 silver. And it could go to 3%, as $150 silver. Actually, I think it's 180. That's 180. 2.5 would be 150. $180 silver. These are possibilities, but it's not as easy to understand as gold, because the path for gold is we kind of understand it. It's going to be somewhat stable and it's going to go higher. Whereas silver, because of this investor demand and because of this possibility of shortages, it creates these massive unknowns. For instance, silver could be at $75, and we'd be sitting on our silver stocks and we're up, two baggers, three baggers, and we think everything's great and we're riding it, right? We're just going to ride this thing to $100 silver. We can get our five bagger, right? The government could come out and then all of a sudden a shortage hits in silver. The government can come out and basically they could do a number of things to provide inventory for all these fabricators. Like, so Tesla can't make a car, Apple can't make a phone, Sony can't make a TV. Those guys are going to start screaming, we need help, we need inventory. There's no inventory, right? So if they did that, silver could drop 20, $25 in a single day, depending on what they choose to do to create that inventory. And our silver stocks are just going to get obliterated. Now, so that's the kind of volatility that we're going to have to deal with. We don't know when it's going to hit, how volatile it's going to be, but it's going to happen, I think. But the good news is, if you got to be patient, even though they can only do this one time. That inventory is basically right now, it's in these ETFs. They got that's where the excess silver is sitting in inventory, but it's not for sale. So they'd have to empty those ETFs out. And if they did, but they can only do it one time. And
Yeah.
if they do, and if they do it, people are going to know, well, they did it once, they're done now. And now the next shortage, there's nothing they can do about it. So at a certain point, silver will start going back up, but we'll have to deal with the volatility. Then once it goes back up, then they can do something else. So I think the first thing that they would do, the low-hanging fruit, was they'd empty the ETFs, and they basically all that inventory would go into inventory where the only people who could buy it would be the fabricators, and that's about 1 billion ounces, and that would get them through quite a while, I think. So I don't think they would have to go to stage two. Stage two would be limiting retail's ability to buy silver. Now, they couldn't do that globally. They can empty those ETFs fairly easily because they exist in the G7 nations. So the G7 nations could just all agree, let's get rid of those ETFs. But the ability to buy silver, they couldn't do that globally. But they could restrict it in like the G7 nations in the West. But these are kind of possibilities, if you will. But I am expecting a shortage at some time, and I think the weak link is the LBMA.
So to play devil's advocate on that a little bit, I've heard about aluminium. There being a bit of a like a stress point where they could start to the ability to replace the industrial uses for silver could be replaced by aluminium just because it's cheaper. It's not as good, but there's like a breaking point. But do you see that as a potential possibility, or is aluminium just too inferior to ever really make a big dent in the silver game?
Before we continue, be sure to subscribe to our channel and ring the bell to get notified about our latest videos.
I don't think that would. I could also use copper as well.
Yeah.
Uh, I I don't know if that would be enough, if you will, to prevent the volatility that I'm expecting, shortages. I still think it's so easy for them to basically empty those ETFs. I still see that happening.
Yeah.
And
Yeah.
there's no legal reason for the ETFs to basically sue the government and say, you can't do this. This is our business. They can in all financial instruments, all those ETFs, the governments have the legal ability to determine, because it's a security. In other words, it's easy, it's low hanging fruit. If they want to shut down an ETF, they can shut it down with no problem legally. So since it's easy to shut down, there's a billion ounces. Let's go get that.
Yeah. Yeah. Yeah, absolutely. No, I definitely see where you're coming from. But yeah, well, it'll be interesting to see where the silver price goes from here. But if we keeping the topic on silver, the silver gold kind of price ratio, I heard you mention it before, like yeah, it was only at 1%, it could be going up to 2. How closely do you monitor that? And do you think it's really got that close tie that it used to have historically, or are things actually a bit different this time? Like, what's your thoughts on that?
Um, I definitely believe that history will rhyme. And so 1980s, it actually went all the way to 6%, which was all the way down to like 17. And it depends on the way you divide the numbers, right? Silver into gold, gold into silver. But I think, and really believe that it will expand. It won't stay at a little over 1.1, 1.2%. I don't where it's at. I like to use the percentages because it's really easy. I follow it very closely, and I definitely believe and expect for that percentage to increase significantly. So I think 2% is a very conservative number. I think it's going to be somewhere between 2 and 3 at the top. And the higher gold prices go, the more I think will go above 2%. But so 1% is easy peasy, right? So you just take $4,000 gold, 1% is $40, and then 2% is 80. So we should be much closer to 80 than 40. And we're at 50 right now. And so we're kind of on the low end. So I think we're going at least to 2. So I'm always focused on gold. For me, gold is the big dog. Gold will Silver will follow gold, but gold will be the leader because gold is such a huge, absolutely massive market. If you look at the dollar amount of gold that's traded on a daily basis, silver's like, a hiccup. And so gold is the big market. Gold is what the central banks buy. They don't buy silver. They buy
Yeah.
gold. And countries buy gold for assets. They don't buy silver. So gold is the big dog, and silver is just coming along for the ride. It just the reason why it comes along for the ride is it becomes a monetary metal because people they can't afford gold. There's not very many people, families, if you will, who basically have $4,000 to buy 1 ounce of gold. Now you can buy, you can buy jewelry, which they do in India quite a bit. You can buy smaller pieces of that. But investors, they tend to want to buy 1 ounce because if you buy below that, tends to have more premiums, especially with smaller coins. But so it limits the buyers, but it's easy to buy silver. So silver becomes a secondary monetary metal. And so silver will follow gold. So I think that as gold goes higher, so we look at, 6,000, we're almost to 5,000. You go to 5,000 at 1% is 50, 2% is 100. And I'm actually, that's my target. 5,000 gold, 100 silver, which is the 2% number, which is what I'm expecting. But
Okay.
silver historically has outperformed gold once it becomes a monetary metal. So when silver's down at 1%, the irony is it's mined at 10%. So it's like it's the price at 1, mined at 10. So there's a big disconnect there on supply. And the reason why is because gold's the monetary metal and silver is a commodity. And so it's not traded as a monetary metal. But as silver becomes a monetary metal, as it becomes a proxy to gold, as investors become more interested in it, then it has to squeeze, if you will. That percentage has to go higher. So it's inevitable I think, I could be wrong here. It's inevitable that I think that silver should outperform gold in a crisis, which we haven't had the crisis yet, right? But in a crisis, so then I think silver starts to outperform gold, and you get that 2%. And I think we're going to be somewhere between 2 and 3. I think 2 is a very conservative number, somewhere between 2 and 3. And it's not crazy we could go above 3. It's possible. So I think 2% is a pretty good number to use. And like I said, the reason I'm in gold and silver mining stocks, the only reason I'm in it, period, 100%, is because I'm expecting a financial crisis. That's the only time gold and silver do well. It's a terrible business. I'm not in gold and silver mining stocks because it's a good business. It's a terrible business. I'm in it for the leverage because I'm expecting a financial crisis. And we're starting to see that, right? More and more people are starting to notice maybe that $38 trillion debt that the US government has is a problem. People are starting to notice it.
Yeah. That was going to be my next question was what is that crisis point that could potentially turn things around for gold and silver? But and you mentioned the debt, so let's dig into that a bit further, because I saw recently that the US has gone over $1 trillion in interest payments annually. That's just a astonishing figure for me. But I mean, how much longer can they keep doing this? Like, what's the time frame are you thinking?
Right. I actually think it could be weeks away. That's how close I think it is. I've said this on several podcasts that the only reason that gold's at $4,000 is the U.S. bond market. If the U.S. bond market was solid as a rock right now, nobody would care. Nobody would be selling their U.S. treasuries. Everybody would be happy with dollars. Everything would be under control. We wouldn't have an inflation problem. The bond market created the inflation problem by borrowing too much money, printing too much money, and it's basically we're on a doom loop where we can't stop spending, and so the more we spend, the more debt we create. And now we got interest payments, and then you create inflation, and then interest rates go higher, and there's no way off the wheel. We're there. The only market that hasn't really acknowledged that we're in a doom loop is the stock market. The stock market is like, everything's fine. We'll just keep kicking the can. Everything's great. We got the Fed. They can manipulate the rates. They can print the money. They can create liquidity. Everything's fine. Everything's fine. And that's exactly what you would expect at the top of a market, because everybody's made all this money and everybody's giddy and everything's doing great. Yeah, we're in the euphoria phase. We just keep making money in the stock market, and then you create these bubbles, right? And that's exactly what we have right now. The PE, the forward PE is like 23 on the S&P. All-time high was 25 and 99, but the reason why it was 25 is because that was when we had the dot-com bubble, where all these companies that had these massive PEs. And so we don't have that today. So in many respects, the current PE is actually on legitimate companies. So it's actually, I think it's actually at an all-time high right now because, like I said, the PEs in 1999 were kind of, they were fake and everybody knew it. I mean, you had these $200 PEs all over the place. So I don't think this stock market can withstand the debt problems. So that doom loop that I talked about, how the government can't stop spending, and all you can do is just print, and that creates more and more inflation. And inflation slowly, and we're seeing the inflation slowly and slowly. It's like a cancer. It slowly weakens your underlying economy. So the cost of living has gotten to the point now where the average family cannot pay their bills, and they're just living paycheck to paycheck, and there's no way out of it. Once you get into this doom loop situation, productivity, they talk about AI is going to bring back productivity, and productivity can raise incomes. But the problem is AI is a job destroyer initially. It's like when we get the productivity numbers from AI, and who knows how many jobs are going to get destroyed in the process. It's not a real smooth transition. And so, yeah, we're kind of trapped here. And so the stock market, I use lots of analogies. One of them that people always use is the Titanic, where the band is moving the deck, moving their chairs around, right? Let's go over here, right? Well, the ship is going down, right? Well, I actually think that our economy has already hit the iceberg, and we're just in denial. We're the band, right? We're in denial. We're just playing, right? And the band's still playing, but the music's going to stop really soon. I think. I said could it happen we could be weeks away from this. The last shoe to drop, I think, is the stock market. The S&P is everything, I believe. Once that S&P rolls over, once we go into recession, that's when this debt bubble, because we did not attempt in 2008, we did not attempt to fix the underlying problem. We papered it over with money, and we lowered rates, and we manipulated the economy. We actually took the rates down to zero. There's no inflation. Let's just take rates to zero, right? You talk about manipulation, right? And so, it was insanity. And we were not going to, instead of fixing the problem, we'll just take rates to zero. And we've been manipulating it ever since, and we've been creating a problem ever since. And it's like, it's mind-boggling when you think about it, that people are putting their money in the stock market with no underlying foundation there to basically fix the problem, or it's like I said, we already hit the iceberg, and everybody's in denial.
Absolutely, yeah. Well, I mean, speaking about keeping the topic on the US economy, I heard you mention that there was kind of like a fundamental shift that occurred when the Ukraine, I mean, together with COVID, but the Ukraine war being the real kind of straw that broke the camel's back, changing the way that the entire global economy functioned and viewed America as far as being the backbone of that. Did you want to dig into your thoughts there?
Yeah, I think it's a very pertinent question, because I really believe that the Ukraine war was the kind of the bubble popping, if you will, that was me crossing the Rubicon. So we've been kicking the can down the road for decades, using manipulation, using debt, and also using foreign money to prop up our standard of living. That actually started in the 80s. So in 71, when Nixon took us off the gold standard, from that point forward, we didn't really move into globalism in the 70s, but we moved into it big time in the 80s. And that was, when we went into globalism, we basically said, so we're no longer a mercantilistic economy, but services is going to save us. We're going to be a services economy, and we're going to let the foreigners make the products, and it's going to be more productive, and that's going to bring up the wealth of the world, But in actuality, it was like it was kind of corporatism, where the corporate world said, we want to go make products over there in China for pennies on the dollar and then bring them back to the US and sell them to the US consumer and make a bunch of money. And Reagan was going, yeah, that's a great idea. Go for it, right? So globalism, and it wasn't in the interest of the US. It was kind of in the interest of the US consumer, but who it wasn't in the interest in was the country as a whole and the middle class. So that was when the middle class started getting hollowed out. That was kind of and everybody was in denial. And now it's become very obvious, and that the middle class has been hollowed out through globalism. Now, and Trump is putting his tariffs on, and he's trying to turn that around. He's trying to bring the manufacturing back. We got to bring the middle class back. If we don't have the middle class, we're toast, right? And now we have this big debt bubble. We got to do something about it, right? Basically, the tariffs were a policy that was implemented out of desperation. So we're desperate now. We don't have enough income. We'll plug that hole with tariffs, and then we'll use that. It's basically a win-win for us. We get more income, which will help our bond market, and then we'll use those tariffs to put pressure on them to bring the manufacturing base back. But the problem with that is tariffs are not a good economic policy. We know historically tariffs are bad. They're basically a net loss for the consumer. They're not good. And so if we're using tariffs, something's wrong. Now let's go back. So I'm just giving you kind of an overview of the overlying problem that's existing. Now, the reason why Ukraine was kind of the pin that kind of popped the debt bubble was exactly what you said. It was that the rest of the world now is kind of reorganizing international trade because they're tired of using the dollar. We're exporting these dollars, which are inflationary. And so when they buy those treasuries and they buy the dollars, it doesn't help them as a country. It actually hurts them. So they're de-dollarizing, and they're like, they don't want to use it. And so that was like the war in Ukraine. It brought China and Russia and India all together. And then they already had the BRICS. They already existed. China and Russia and India are already that's 3 countries of the BRICS, right? It's the majority of the BRICS. So they decided, okay, we need a new international order. Let's just expand the BRICS. And so that's when BRIC expansion began. And then the US decided to steal, if you will, $300 billion of Russian assets. And just basically, they froze them, and then they basically grabbed them and said they're ours. And so when they did that, and then they kicked them out of the SWIFT system, and so the rest of the world goes, oh, they can do that to them, they can do that to us too. And so that kind of sped up the BRIC. That basically, the US became like, this entity that the rest of the world no longer trusted. And so that trust started to break down. And so now we're seeing a big move away from US treasuries by foreign countries. I mean, if you look at it historically, how much the percentage of treasuries that they bought, especially anything 10 years or older, but we haven't been issuing very many of those lately. But even when we issue them, they don't show up to buy them, and they're selling them. So we've been exporting our debt since the 1980s. That's one of our main exports, is exporting our debt, which is our treasuries. We sell them to foreigners, and then they use those dollars to buy our goods or buy our assets. Or buy other countries' goods, because the dollar is the global reserve currency. So you're right. The Ukraine war was an absolutely important historical event, much more so than this war between Russia and Ukraine. It was an epic historical event, and how it impacted international trade, and I believe the end of U.S. global hedge money. And so that is putting pressure on our economy and putting pressure on the stock market. But the stock market is in denial. It's like, oh, that Ukraine war, no, everything's still the same. Everything's normal. It's like, and the reason why Wall Street is 20% of global GDP, and it's very powerful, very potent, and they tend to be able to control the narrative. So you don't see very many talking heads, if you will, on TV talking like me. Right? Yeah. You don't hear that because they control the narrative. It's basically just positive spin that everything's normal, the U.S. economy is fine, and so all the focus, whenever you hear anybody, you don't hear very many voices talking about international trade and the trend and what's happening, and so the only way you really learn about that is really on the internet and kind of social media. You don't learn very much on TV anymore. It's very controlled. It's kind of bizarre how controlled it's become. And
It's
so,
funny it's funny you say that though, but the whole fake news that Trump has been running so hard that it's almost backfired a little bit, because people don't trust the Fed now either, because that could also be fake news. So yeah, it's an interesting one, isn't it? And that's where people like you kind of giving the facts is a fantastic and refreshing resource out there. Now, if we shifted over just to investors and how, I guess not advice, but if you could provide some of your kind of tips for investors.
well, the first place to start is my book, because like I said, when I started investing in mining stocks, there wasn't any books that explained it. And so I wrote a book, and it's almost like a textbook, but the one thing that's good about it is very thorough. So I explain each of the different categories, the majors, the mid tiers, and the explorers. And I explain how to analyze them, what to look for. So it gets you up to speed fairly quickly. So if you want to know, I mean, it's kind of complex, so I can't really talk about it in 5 minutes.
Yeah.
I have different approaches for each category, for the producers, the developers, and explorers. I have a different approach for each one, and you have to learn that. You can't treat them all the same. And so the one thing that it's somewhat unsettling to me is that people are treating gold and silver miners like regular companies, regular stocks, like Microsoft. Gold price is up, let's go buy Newmont. It doesn't work like that. You can do the ETFs. There's some places in the world that you can't get access. There's not that many. There's only like 3 silver miner ETFs in the world. And so some countries can't have access to those. And so it makes it difficult. But if you have access to the ETFs, then you can do that. And then you could buy, okay, I'm going to buy the gold miners, and then your risk is a little bit reduced. But even the best of the best majors like Agnico Eagle, Newmont, and Barrick, even those stocks can have massive volatility. And some people don't realize those stocks aren't going to have as much volatility as a silver miner, but they can have significant volatility. I always say you don't invest into mining stocks, you speculate because the volatility. I mean, we had, for instance, GDXJ was up 130% for the year. 130%. Now, Newmont is up 100%, maybe a little more than that. I think Newmont was up even more than that, 100% for the year. Now, you don't get those kind of moves without, volatility. So it's not really investing; it's more speculating. And so, my book is really useful to understand exactly what you're buying. So you get an understanding of why they're volatile, what makes them tick, what makes them, what pushes the price up, what pushes the price down. So a lot of people, like I said, they don't realize how much risk they're actually taking on. And earlier in this conversation, I talked about it's possible that silver prices could go to $20 in one day. It's a possibility, right? And so you need to have a mindset of knowing what you're actually buying, because a lot of people, it's like their life savings, and they'll put a big chunk of it into mining stocks, thinking it's just I'm just buying a company, I'm buying a stock. It's not like that. So that's kind of my investment advice today.
There was one final question, just because I find this one interesting. You mentioned ETFs in silver. because I'm primarily, as you said at the start, Australian, so I'm most of my time spent on the ASX, and you're exactly right. There's no silver miner ETF on one of the largest stock exchanges, especially for mining and exploration companies in the world, and it blew my mind. There's this physical one, but do you think there's going to be more ETFs popping up in the silver space over time, or where do you see that going?
Maybe, but this cycle is going to be very kind of short-lived. There probably won't be enough time. But I actually tweeted out there, I wanted to actually create a silver ETF on the ASX, and I actually
Right.
created one. Okay, somebody called me. Let's go ahead and build this thing, but nobody did. So I was hoping to create one. You're right, there isn't one on the ASX. And
I would have
then
loved. I would have been in it, mate.
yeah, I wanted to put it on ASX, and I wanted to put it on London and put it in New York, because there is very few. And the other thing is there really isn't a pure silver miner ETF anymore. All three of them include gold miners, and then royalty plays as well. Because the reason why is because they need liquidity, and there's not very many. There's very little liquidity in the silver space. There's only 15 silver miners with market caps over $100 million. So the size, the problem is the size, but there's ways around it. I mean, you can limit how many people can get in. You can do some types of limiting the size of it. I don't know how to work around that. There's only 15, and there's only about 80 silver mining companies worth a darn, if you will, 80 in the world. There's more than that, but they're tiny, and they really don't have any value. They don't have very much value.
Or they're a byproduct.
So there's I have a list of silver miners and that I think are kind of, investable, if you will, and there's only about 80 of them. So, but the problem is those ones from like 30 to 80 have very small market caps, very low liquidity. And so that's the reason why you don't see any silver ETFs. As a matter of fact, the three silver ETFs that exist, like I said, they're not all silver. They can't do that. So they have a bunch of gold miners in there and royalty plays for liquidity.
Well, maybe, like you say, it's something for the next bull run when in the 2030s or the 2040s or whenever that happens, when people have got time to set it up in time. But Don, it's been fantastic talking to you, mate. I got a lot out of that, and yeah, appreciate you coming on, and yeah, look forward to talking to you again soon.
Yeah, thanks for having me on, John.